Palantir Technologies has delivered a truly extraordinary performance in the stock market over the past 12 months, with its share price rising by over 600%. This type of performance is incredibly rare for any publicly traded company, let alone one that already had a sizable market capitalization of about $54 billion before the surge. A move of this magnitude has turned the stock into a strong candidate for investors who prefer to buy and hold for the long term. However, while such a sharp increase in price is an impressive achievement, it does not mean much to people who did not own shares during that period. In fact, for those thinking about investing now, the large jump in value can also create hesitation. This is because steep rallies can often be followed by pullbacks, and some may wonder if a correction is inevitable after such a rapid climb. The real question now is whether Palantir can keep delivering exceptional growth over the next 5 years. No one can predict the future with certainty, but it is possible to evaluate certain factors that can help investors form an educated opinion. One of the first points to consider is valuation. Palantir is currently trading at extremely high levels by nearly every conventional measure, and that makes it harder for the stock to keep up the same kind of explosive performance. High valuations essentially mean that a lot of future success is already priced into the shares, which raises the bar for what the company must achieve to justify its price. Right now, Palantir is valued at 274 times its expected earnings for the next year and 98.5 times its expected revenue. Its enterprise value, which is calculated by taking the market capitalization, adding debt, and subtracting cash, is roughly 97 times its forward expected revenue. To put these figures into perspective, these ratios are more than 6.5 times and 4.5 times higher than those of Nvidia, which is itself already considered highly valued by most investors. The forward price-to-earnings ratio is especially important here because it shows how much of future growth the market is already expecting from Palantir. When a stock trades at these levels, it means that to maintain or grow in value, the company must deliver outstanding performance for years without major missteps. While this is possible, it sets a very high standard and may not match the typical investor's idea of explosive growth. If you're expecting Palantir to deliver another 600% gain in the short term, that is probably not realistic. The massive gains over the past year are partly due to the company's strong financial results, but also partly due to high investor enthusiasm. For example, in the second quarter, Palantir achieved $1 billion in revenue for the first time in its history. The bulk of this came from its United States government contracts, which grew 53% year over year to reach $426 million. However, the most eye-catching performance came from the company's United States commercial business, which grew an incredible 93% to $306 million. This commercial segment is expected to be Palantir's fastest growing area in the near future, and Chief Executive Officer Alex Karp has stated that he believes the company could increase its United States revenue by 10 times over the next 5 years. Even if that happens, though, the company's current valuation would still be expensive compared to most other stocks. It is also worth remembering that the stock market often behaves in ways that do not seem logical. High valuations do not necessarily mean that a stock cannot continue to rise, but they do mean that there is less margin for error. This is why it might be risky to approach Palantir with expectations of quick extreme returns. A more measured approach could be to invest with a long-term perspective and prepare for a bumpy ride along the way. One investing strategy that could help reduce risk is dollar cost averaging. This means buying shares in small amounts at regular intervals rather than committing a large sum all at once. Doing this can help smooth out the impact of short-term price swings and reduce the chance of buying entirely at peak levels. For instance, if the stock were to drop after a purchase, the next scheduled buy could be at a lower price, which would reduce the average cost per share over time. This method is often used by investors to manage volatility and avoid emotional decision-making. Another important consideration is what major institutional investors are doing. Recently, Cathie Wood of ARK Invest sold 153,338 shares of Palantir over 3 consecutive days from August 6th to August 8th. The total value of these sales was about $28,001,000. These transactions took place just as Palantir's stock reached a record high of $186.96 on August 8th, shortly after the company reported strong second quarter earnings on August 4th. It is important to note, however, that despite selling some shares, Palantir still remains one of the largest positions in ARK's portfolio. It is currently the 7th largest holding in the ARK Innovation Exchange Traded Fund, making up 5.04% of the fund's total value. This suggests that the sales were likely part of a profit-taking strategy rather than a loss of confidence in the company. Cathie Wood often trims positions after strong rallies to free up cash for other investment opportunities, while still keeping meaningful stakes in companies she believes in over the long term. Ultimately, whether Palantir will continue to grow rapidly over the next 5 years will depend on its ability to maintain high growth rates, expand its commercial business, and meet or exceed the lofty expectations already priced into the stock. Investors need to balance the excitement of Palantir's recent performance with the reality of its current valuation. While there is potential for continued success, there is also the possibility of slower returns or significant volatility along the way. As with any investment decision, it is essential to conduct thorough research and consider your own financial goals and risk tolerance before buying or adding to a position in Palantir. Being realistic about expectations and planning for the long term can help you avoid disappointment and improve your chances of success. In the end, Palantir Technologies has seen its stock price soar over 600% in the past year, driven partly by strong financial results such as reaching $1 billion in revenue for the first time in the second quarter, with United States government revenue up 53% year over year to $426 million and United States commercial revenue surging 93% to $306 million. Despite this growth, the company's valuation remains extremely high at 274 times next year's expected earnings and 98.5 times projected revenue, far above many peers including Nvidia. This makes continued explosive growth challenging without years of exceptional execution. While investors like Cathie Wood have trimmed holdings recently, Palantir remains a significant position in major portfolios, and long-term investors may consider dollar cost averaging to manage volatility. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.